Hi, everybody. Jim Kruzan here, and welcome to the November review. As we've been doing every month now, we've been kind of taking a look at economic data, market information, and just to get a general sense for where the month kind of shook out. Um, as we said before, and have said often, look, we look at this data with the idea that one of two things will happen. Either the data will continue to weaken and we'll wind up in a recession, or the data will actually start to improve, indicating somewhat of a soft landing, and we've been through the worst of this. Um, for the last several years, we've gotten this continual decay of data, specifically the leading economic index, as well as some other tertiary data as well. These days, the data is really quite mixed. And as a result, it's awfully frustrating. With the government shutdown, we haven't had an update on the leading economic index. Um, the last we looked at it, it was declining, and it continues to decline. That is to say, the data surrounding it does. But the LEI, well, frankly, it's missed 2 months. So where we left off, big drop that one particular month. That was the month of August, reported out in September. So we really don't know much else about this. Beyond that, a lot of the other data has been somewhat mixed. The Conference Board Conference Index declined in November. Credit card delinquencies have risen slightly. Their card accounts are delinquent 90 days, not typically what you'd see in a great economy. U.S. consumer credit continues to rise. Mortgage-backed securities, that would be commercial mortgages, that delinquency rate is still quite elevated. That was just updated this past week for November, dropped slightly, 11.56% versus 11.7%. So a slight improvement there. Manufacturing PMI and new order index both continued to drop. The Philly Fed index increased. The Chicago Business Barometer, kind of same report, different Fed bank, dropped. So it's somewhat, as we said before, a mixed bag. Beyond that, inflation isn't particularly problematic. We're nowhere near the 2%. And in fact, core CPI stayed the same as it was the month of September at 3%. At the same period of time, we had initial jobless claims that was reported a week ago. They fell. This week, which would be the week of Thanksgiving being reported, they were quite benign. There weren't a lot of new claims filed. But also this week, the ADP report showed a huge drop in the number of jobs, or I should say, a huge increase in the number of jobs being shed, or a big decline in jobs. And the unemployment rate also ticked up. So as I said, it's somewhat of a mixed bag. Beyond that, the other edge of the sword is that valuations continue to remain very high. The Buffett indicator, which we've spoken about before, is now 230. Long-term average is more like 70. So it's extremely high. If we look at it currently, that is as of this week, it's 223, still quite elevated. And as you can see from the chart, quite a bit higher than we've ever seen it post before. So that's indicative of a very expensive market. Another way of viewing the same thing without looking at data over GDP, but looking at corporate earnings, price over earnings, is the Shiller index, which uses inflation adjusted rates. So you can look at numbers today and compare those to decades before. They also use a cyclical 10-year adjusted earnings So it smooths out some of the, let's say, accounting shenanigans that could be used over a year or two. And with its all-time high being 42 or 43, that was back during the dot-com era. Where we're at right now is right up against 40. Again, a high, much higher than it was during the um, financial crisis, much higher than it was during the Great Depression. The only time it was ever spiked higher was during the dot-com bubble. So again, quite high elevations. As far as the market is concerned, November was pretty benign. The S&P 500 was up fractionally. The equal weight S&P was up nearly 2%. Large cap value was up 2.5%. So we're beginning to see a little bit of a broadening out. And as we'll see in just a moment, part of the reason for that is the Mag 7 didn't participate or didn't play much in the month of November. So it was many of these other areas that started to show some outperformance. Bonds were also somewhat benign, with long-term treasuries actually losing a little bit of value as interest rates ticked up, and short-term bonds gaining a little bit of value as the expectation of continued rate cuts continue. The US dollar rose slightly for the month, yet it has fallen 8.5% for the full year, and gold was up a robust 5%. So when you look at a balanced account, a 60-40 blended portfolio, if we used US S&P and the Barclays Agg, it was up 0.34. If we use an equally weight index, it was up 1.2. First time in a long time, the equally weight benchmark actually outperformed the MEG concentrated S&P. And as I promised, we would look at the Mag 7 numbers for the month of November. They actually contributed a negative 0.5%. Now remember, the S&P was actually up 0.3%, which is indicative of other things actually outperforming. So we got a little bit of a positive skew. For the year, however, Mag 7 still contributes more than half of the total return that the S&P has had. And by anyone's measure, that would certainly be a concentrated return scenario. One other thing to consider is the Mag 7. Currently, in terms of price valuation, those 7 stocks represent 34.8. We'll call that nearly 35% of the total index. Remember, the S&P is currently, with some splits and mergers, of 503 stocks. So 7 represent over a third of the index by size. That's extreme concentration. And the top 10 largest companies represent now over 41% of the index. Extreme concentration, which is also a bit of a concern. So we are trying to avoid those overextended areas, kind of playing the fact that the market at some point needs to broaden out. There needs to be some mean reversion. And that's frankly been our story for the last few years. With that, that kind of concludes the message for November. December typically is a good month, kind of a Santa Claus rally. We'll see if that is in fact the case, as we'll review December and the fourth quarter and the full year sometime early in January. That said, have a wonderful holiday season. If you have any questions, please reach out. Otherwise, we'll talk to you again real soon. Take care.